stuff. Gonna talk a little bit
We do
about
got some
Q3,
good topics.
Q4, maybe a little sluggish, slowdown of our economy, some maybe price increasing occurring, and then the iBuyers market is duking it out. There's a TikToker that got viral pretty quick about this. I have some theories myself. Obviously, there's a conspiracy theory going on with the TikTok, but let's break into it. Got chill deal here. Going to be talking about Q3, Q4, possible cooldowns happening here. What do we got going on tonight?
Yeah, it's really interesting. So obviously we know there's so many crazy things. We've talked about it all the time. So you guys, hopefully, if you're listening every week, are pretty informed. Talking about inflation all the time, GDP growth, stagflation, all these things we always talk about. Or at least I talk about. I think Nate
Mm-hmm.
maybe agrees or disagrees sometimes, but really interesting. The last 2 weeks, we've had two downgrades to Q3 GDP growth. So obviously, 2021, we've had pretty insane growth everywhere, really, but especially the markets and GDP. From 2020 or 2020 having some negative growth to 2021 having like 6 or 7 GDP growth in Q1 and Q2 are pretty outrageous numbers that we've never seen. And I think a lot of economists and banks and financial institutions were kind of thinking that we're going to continue that trend, but we're starting to get downgrades in GDP growth. So there's
Mm.
two major ones that happen. So before there was expectation to see 6.5 to 7% growth in Q3, and there was one ground downgrade to 5% and a second downgrade to 5.5%, which is pretty significant. A 1% to 1.5% decrease in expectation for GDP growth is pretty significant. And so the first one we look at, we kind of see here Q3, we're expecting a 5% growth. Before we were expecting a 6 and 7% growth. And not only that, but there's also a decrease in expectation for consumer spending. So seeing 6 and 4% as numbers, but for Q3, they're expecting it to go down to 2.1%. So seeing that GDP pullback, seeing consumer spending pull down are really significant and really significant numbers. Because what's been happening, we all know it, is that inflation has been basically moving up pretty substantially. We've talked about it a lot. Here's another article, not from the Prophet, but from
See,
Costco, Nike, and FedEx. They're saying that we're warning that basically we're going to have more inflation hit consumers in holiday. So around July and June was like the first wave of companies coming out and saying we're expecting substantial inflation in prices. And kind of the talk around that has died down, but just, 3 months later, we're having these big companies set expectations or warning us that holiday prices are going to be significantly are going to see a significant inflation. So you know really it's like, how is that going to impact consumer spending is my main thing. Like, if things cost more, we're already expecting consumers to slow down and spend, but we're still seeing inflation come up, we're seeing GDP growth come down. So we're starting to get to a point where consumer price index and producer price index is higher than GDP growth, which is not a good sign. We've been talking about this since I think March. We were like, we think, CPI numbers are going to get to 6 to 10%. Ta-da! Um, but now we're seeing those stay elevated, but we're seeing job growth or unemployment stay flat, still elevated numbers. We're now seeing even more layers of inflation. So right now, inflation is kind of stagnant, but now we're seeing from all the big companies saying, no, expect higher prices to start flooding in this holiday season. And so we're seeing, the important things like more people getting jobs is slowing down, GDP slowing down and decreasing, but prices are going up. And so I've been talking about it for a while, but really what that means is stagflation. And I've been talking about it forever. I talked about it, I think, since March, that we are probably heading towards a period of stagflation. And we're starting to potentially see that. And we're not seeing a let up of the shipping issues. The Fed is still spending the same amount, which is another thing that pushes up prices. Um, and so there's nothing in sight that's saying that this is going to slow down, which is a a serious scenario. Um, but I just talked for like 10 straight minutes. But I'm really curious what you think, Nate. Like, do you think that, that these warnings are maybe they're being a little, I guess, dramatic to like just like, okay, we don't want you to keep buying our stock like crazy and get our prices too high. Like, we want to keep a reasonable expectation, and maybe they're scaring people more than they need to? Or do you think that these things are actually going to happen into Q4?
I think they could happen in Q4. And if stocks were too crazy high, right, they could obviously do a split stock and say, Apple's done that a couple times, a couple of their stocks have as well, if they're really concerned about investors coming in and buying up, et cetera. And then obviously massive buybacks are going to be happening. They're already happening. Microsoft, I think, I forget the other company that just came out and said it the other day. Part of it
All
being
of them,
the
yeah.
tax bills, yeah, in the Biden administration. So I think there's a compounding factor here of not only GDP, like you were saying, also Nike closing down 80% of their footwear factories in Vietnam are closed down. So then talk about the shipping concerns that we have that I think you're going to talk about
Yeah.
again. We've talked about this consistently, the shipping from overseas, and we all know Vietnam is a hardcore producer of our goods. We're not going to be able to get those in time for Christmas potentially. So there's all of these factors that we have to consider, obviously, and then the pricing of the market. And so as we're looking at this, I did pull up some charts to kind of see what's happening here in Nike. They are going up and down. They dropped this last day, obviously, because of the news about their factories closing for a little bit, maybe indefinitely. Who knows how long that's going to take? But I think there's way too many factors just to point to causation. I think there's a lot of correlations happening
Yeah.
simultaneously. And then as we're running into Q4, maybe even Q1 of next year, we're going to see things kind of shake out a little bit more, obviously, after Christmas. Um, who knows? There's a huge demand right now and very little supply happening. So that's my thought going into this.
Yeah. I mean, you talk about the shipping. I saw an article yesterday. I didn't bring it up, but there's an article that said that there's 100 ships waiting in the port of LA. A
Yeah,
hundred ships, which is insane.
I'll
And
actually
so
try
you
to
just
pull it up right now.
see the backlog happening, and the main reason I want to bring this topic up, bringing it back to stocks, is Q3 earnings is going to be insane. So when we look back at Q2, I think it was 89% of the companies beat earnings in Q2, which is like basically an unheard number. We've never seen anything like
How
that.
many?
I think it was 89% of companies beat earnings in Q2
89 in S&P or in all the market?
and
All
S&P.
4,000 oh wow, okay.
Yeah. So what is that? 500, like 400 and something companies.
Yeah, roughly. Yeah.
Um, and so I bring that up because I think Q3 is going to be much different, and you really need to be selective on the stocks if you're trying to play earnings. Pause this video. If you're trying to play earnings, if it's not just going to be a buy and expect it to go up quarter. It's not going to be like last quarter because basically there was companies that moved down on earnings, but everybody beat, and I think we're going to see a much different story. Bringing up Disney saying their sub growth, their subscription growth warning, like it's slowing down significantly. We're not seeing the spurt we saw during COVID from everybody staying at home more and watching TV. Um, General Mills is another one. So General Mills came out and said we're continue to have supply chain issues, expect prices to increase significantly. And what's really interesting about this one is, and this has to go with job growth. At the same time, 2 months ago, General Mills said that they're cutting 1,400 jobs worldwide. So I think what we don't know what's happening in the back end is prices are going up so significantly for these companies that not only do they
Mm.
have to raise prices, but they also have to cut jobs, which is like the worst case scenario. Like that's that's not what you want to be happening. And so just to keep an eye, like pay attention, Q3 earnings is coming up. I think this week we start or last week we started the first earnings. General Mills had their earnings, but we're starting to have more earnings coming into next week. And I think in 2 weeks we have like the Googles of the world have earnings. So be really careful around this Q3 earnings time because I really think that there's going to be a lot of companies that do not hit earnings and they're going to miss earnings significantly. And part of the reason is for the last 2 quarters, all these companies have been increasing their expectations for the quarter. Everyone's been upgrading their expectations for revenue targets. Like, oh, we're expecting, 5% more revenue, 10% more revenue coming into the end of 2021. And so now what we're hearing is that a lot of these companies are actually having growth issues. And so you have a high expectation, but you have a low actual might happen. And so that creates a really dangerous position depending on what stocks you're holding. If you're still holding stocks that maybe are a short-term hold that have gone up, 30% in the last few months, because some stocks have, you really want to be careful heading into the second half of the year, into Q3 and Q4, as we might have some really bad misses. But one thing I want to ask you, Nate, I'm really curious what you think, because this General Mills story was really interesting to me. That General Mills first came out in, I think it was June, and said, we're seeing significant price increases. And then they came out and said, we're cutting 1,400 jobs. And now again, on Thursday, they came out and said, we're expecting even more price increases. So I'm curious what you think about this. More price increases, which in my mind thinks, oh, they're going to make more money, but they're actually cutting more jobs as well. So I'm really curious, like, what you
Yeah.
think is going on there from like a business perspective, and what that might
So
mean
much
for
to
companies.
so much to unpack here. I think a few have been caught with their pants down, if you will, have been blasted on social media for uh, um, decreasing the package, right, of some of the items, whether it's cereal, chips, or whatever. They haven't really come out publicly until after the fact to say, yeah, look, we've had to shrink our packaging a little bit to make up for the costs of doing business, and either because of shipping supply issues and or wage increases that are being shrinkflation. Thank you for pulling that up. That is part of this, I'd say, epidemic, quite frankly, here in the U.S. of how do we battle this? Companies are paying Chipotle, fast food restaurants, on top of all these other folks. There's a huge demand from the worker side. Nothing wrong with that, but it comes at a cost, at a price. Is if we're going to be paying people more money, it gets passed on to the consumer. We've talked about this in different scenarios, but also shrinkage or shrinkflation rather, of looking at this as how do people make up for the cost of doing business? And then the expectations now from the public traded companies is outrageously high. People are saying, because the pandemic's continuing, there's going to be an increase in demand for Clorox goods and all this other stuff, which is kind of paradoxically not true. We've actually seen some of those supplies, the demand come down, not go up. So I don't know if it's because people are very comfortable with their living and okay with it at this point, now that we got the vaccinations happening and so forth. But I think there's a lot, once again, here, just in a worker slash company standpoint, outside of all the other stuff we talked about, kind of this global issue, there's more of this, instead of a pandemic of supply, now it's an endemic of demand that we have here, and costs that ensues with that. So too many compounding issues, man.
Yeah. I
I'd
mean,
love to point to one, but yeah.
you bring up a good point though around. So you mentioned about, obviously, wages have gone up, and multiple reasons they've gone up, but one of the reasons is people are not working, and so companies are having to increase their wages to get people to come work.
And paying
And so
bonuses on top of that,
and
right?
yeah,
Like
work like,
thousands of
yeah,
dollars per person. You
yeah.
multiply that by 50, 100 people plus.
Mm-hmm.
Add a zero to that. That's 50,000 bucks. Whatever it is, fiscal year. But still, you have to report that somewhere. And that's assuming that the retention stays, because it costs a lot more to hire somebody than it does to retrain somebody or maintain them on your team. But I mean, also the consumer price index. I pulled this article up. Feel free to run through it while we're talking. But yeah, that's kind of my stance at this point.
I think it's interesting you bring it up, because I think what's the dialogue that's been happening a lot around jobs is there's more jobs than people to work, and so
Yep. We're hearing
people
it
aren't.
across all industries too, by the way. It's not just
Yeah,
food and
yeah, not
beverage or
just.
retail.
Yeah,
It's
not. Yeah.
we're talking high firms, law firms, all of these corporate areas. In fact, like JP Morgan, I think they just raised it from 100,000 to, was it 125, 150,000? I can't remember. I have to go back and look. But just to have somebody come in out of school, they're increasing the starting pay. I'm like, this is bonkers. Now it's incentivizing the workforce to go work for the banks, as opposed to some of these other industries that might need the human capital, which is then going to increase. It's a vicious cycle, right? people are going to be
But
shifting into different industries. And anyway, I digress.
but I think what's interesting about that is what we're seeing is we're seeing GDP downgrades, we're seeing prices increase, and they don't seem like they're going to stop at least through the end of the year. Have we hit the peak of jobs being? Have we hit the peak of open jobs on the market? That's my question. With costs going up as we're seeing, with wages going up, are we going to start seeing a decrease in open jobs? And it's not because people are just like, we don't want to hire people, but because costs have increased so much
Mm-hmm.
that they aren't going to be able to hire 100 people anymore. They're only going to be able to hire 50.
Yeah.
It's not that jobs are going to disappear, but maybe we've hit the peak of jobs out on the market and people have missed their opportunity to get
Yeah.
jobs at a higher wage because there's going to be less jobs now. I'm really curious if we're going to see that. And that's just more fuel to the fire of I've been talking about
Mm-hmm.
it forever, and it's just because I think it's so important to know is about this stagflation thing.
Mm-hmm.
And I talked about it, I think, the week before last. The keys to stagflation is higher than normal unemployment rates. And if we start seeing, the amount of jobs decrease on the market, like that's going to keep unemployment higher. You see inflation continue to increase or stay elevated while you see GDP growth decrease. This is what we're seeing right now. And the
Mm-hmm.
Fed just had their
Scary.
meeting last week.
It's
And
very scary.
the Fed said we're going to taper at some point, but that's probably not till December. And so from now until December, maybe longer, they say interest rates not till the end of 2022, and that's really going to have the biggest impact on inflation is interest rates. And so we could have another year of inflation continuously going up while we're seeing these other numbers go down. I think I had it on this article. Maybe I didn't bring it up. But yeah, Q4 and Q1. So they're expecting growth to go down to 4.1%, and they're probably going to downgrade that, honestly. And so with CPI maybe heading into Q1 next year still at like 6% or 7%, and seeing GDP growth at 4%, it might even be lower than that, 3% even maybe. That causes severe issues because when you have to think about it, is when wages stop growing at the same rate as inflation, people have less purchasing power. When they have less purchasing power, they buy less goods, they buy less homes, they have less savings. And so it's this vicious cycle where, in my opinion, and I'll say it now because I like to call things early, even if I'm wrong, I think we're heading into stagflation. I mentioned it. I think last month we started to see the start of stagflation. And I think once stagflation's over sometime mid 2022, we're going to see deflation. And it's because all these people have had all their savings sucked up because people bought homes, people increased their debt. There's not going to be many jobs. And so we're going to see a big decrease in GDP, a big decrease in raw materials because people are purchasing less. And there's going to be a ton of cars on the market because they made so many cars for the demand, but the demand died off because prices increased and people have less jobs. And so I think we're going to go from stagflation to deflation. And then I think that could potentially put another rough year for 2022. But that's just kind of my,
Very
who
interesting
knows what's going
thoughts.
to happen.
Yeah.
But it's kind of the thoughts I've been having lately of going from stagflation to deflation, which when we look historically speaking, stagflation and deflation are two of the worst scenarios for an economy, and it typically leads to lower asset prices. Um, and so these are things that have been on my horizon. Um, I think we talked about it last week. We talked about market cycles.
Mm-hmm.
As long as the
Yep.
Fed keeps spending money and we have low interest rates, asset prices are most likely going to continue higher. But we're starting to see a lot of cracks in the foundation. And those are really important things to keep track of. But yeah, I don't know. I'm curious if you have any other thoughts there, Nate.
No, I think you nailed it all. And I just pulled up the other article that we had, the conference board. I think that is what
Yeah,
you
that's the
were,
one.
referring
Yeah.
to.
Yeah.
Item 1, 2, and 3 here: real GDP, disposable income, and the consumer spending. Just kind of going across, consumer spending being the last, disposable income. You're seeing it here. There you go. You got full screen mode.
That's where it was. Like I
Yeah.
know it's somewhere.
But yeah, those are telltale signs of what's to come, and I think that will also shift depending on what Jerome Powell and the rest of the
Yeah.
13 other folks are going to decide here in the near future of like where are we headed as a country from an interest rate, but also fiscal policy, monetary policy from our government here of where do we want to be and where do we want to position, from a GDP standpoint, from a macro to the micro of consumer spending and disposable income. I think we're at one of the all-time highs that we've had savings in this country as well. So what is that going to do? There's a big question mark. I don't know. I don't want to shake my magic 8-ball right now and tell me to try again later. I'd love to have an answer, but we'll see what happens. It's all we have is the historical information in front of us, and then we have this envisioning here with this information here to the best of our ability what we can predict. But you have a great graph up. So
yeah, it's savings rate graph just for context. It's come down to pre-pandemic levels, but it's just a random note there.
Crazy stuff.
But yeah, that's kind of all I want to talk about. I just think it's things that we need to pay attention to. And really, I mean, the main takeaways from that little 20 minutes on this topic is be careful of what companies you're trying to play earnings on, because Q3 earnings, I think, are going to be really bizarre. And companies that we for sure thought were going to hit earnings and beat earnings are not going to. And that can honestly have a lot of impulse selling happen. So be careful playing earnings. And the second thing is save a little bit more money in your life, because prices are going to continue to go up. And we really need it. Like for me, like I'm even thinking like, oh, where can I cut maybe 10% out of my normal life and spending? Because I know that I'm already seeing at least 10% increase in price. And so, I still want to save the same amount of money that I am. So maybe where can I maybe not buy a margarita when I go out and get Mexican food or something, And then the third thing is make sure and buy your Christmas gifts early this year, because I think if you don't buy them, buy back Black Friday or before, you are not going to be getting them for most people unless you go to the store. So those are my 3 main takeaways from our conversation.
Yeah,
A little bit more fun topics, but real life thoughts. But
that's important. And speaking of savings, let's jump into the housing market really quick. We talked a little bit about kind of my endeavor, our endeavors. We'll get into in the future here, but there's pretty interesting stuff coming out of the iBuyer markets, and I don't know if anybody's been paying attention to it, but I'm going to pull up a quick graph of some of the stuff that's happening. OfferPad went IPO. I'll kind of talk about what iBuying is here in a second, but OfferPad, they went IPO through a SPAC, I believe. Oh, wow. Okay. Can't be reached. I'm getting an error on my side. That's a little weird.
Try to bring it up.
That's cool. I don't know why it's not going. But with OfferPad, we have Zillow, we have Realtor that are going into this market. Oh, yeah, thank you. That are tapping into this market here, where we have essentially e-buying, if you will, or iBuying as they're calling it now, where you can literally buy or sell your home online. We've been doing that already from the buyer side as consumers of Zillow's product, or Realtor.com, or some of these other folks, Redfin. It's typically where you look up, maybe pull up one in Austin. I'm curious to see, because I do want to talk about kind of one that Zillow is selling.
Oh yeah,
iBuyer. Yeah. I'm curious to see where we're at with that these days. So Realtor.com, Zillow, obviously kind of taking the lead. They're the known, really the lead company these days that have housing inventory readily available to consumers like ourselves to look at historical prices, but also current prices, what the rent is, looking at comps where you don't have to dig too deep. It's all relatively easy to look at. So thank you for pulling that up. You can see, does it say, I can't read that. Oh yeah,
this home is owned by Zillow.
Exactly. Bingo. This is a whole new phenomenon that's passing through the United States right now. It's sending shockwaves, quite frankly, to our market a little bit here, but probably more importantly, from a stock position, if you're looking at Zillow, you're looking at some of these iBuyers. They've been quite quiet, frankly, since they've really started ramping this up until recently, where people have been selling their homes to them. I have a family member who did it through Zillow, compared notes against their competitor and decided to go with Zillow. But you're seeing it here, the revenue that is coming through Zillow versus like Realtor. Ironically, most of their funds and revenue typically come through the agents that pay to play, if you will, to be on their website, to be the agent that pops up in the window next to the house to say, contact us if you want to buy, or if you want to sell. They have a separate thing. If you have your own property listed, you can work through their system. But you're seeing the revenue growth happen here. Once again, predominantly this is through their services that they provide, which is the agent side of the equation. And then they have this whole new slated opportunity here that's popped up on the bigger window. You're seeing the market penetration that they're looking at getting into heavily on the East Coast right now, but they're opening up offices, if you will, virtual offices all over the place with agents through Zillow, but also through third parties. Kind of think about like Amazon, where they're the platform where everybody puts their products on, but then they're the ones actually doing the transactions and collecting a fee through all of that. So I think it's a smart model. However, I do have some very fair questions I think that everybody's going to be asking here very soon is, have they overpriced or overplayed their hand a little bit here? And so
and we could use an example of that from this
please
post.
do.
So kind of like Nate was saying, so this is a home. So my wife and I are looking at the market. It's really even helping me understand, honestly, main reason I've been looking at homes is really understand what's been happening, because prices have gone up so significantly. So this is a Zillow home, and this is something that's been happening a lot with these Zillow homes is they price them so hot that they've been on the market for a long time. So this home, for example, has been on the market for 105 days. So in a market that's quote unquote so hot, how are these homes on the market for almost 6 months or 5 months? And so obviously people looking at them, but no one's buying it. It's been on the market forever. And the main thing I want to call out here is the price changes, which is insane. So they bought this home this house in May for $411 per square foot. And kind of look at that. That's around like high fours, so 475-ish to 500,000. And they tried to make 30,000 on it on the list price. And basically
What day did they do that?
So they bought it on 5/18 and they listed it on 6/12, so a month later they listed it. And when you look at the price they're at now, 4 months later, they now have the house priced at $379, which is around $100K under what they bought it for, which is insane. So this is kind of like the example of how these companies overstepped. What does that mean for the housing market now? Thanks for the follow, Haas. Appreciate that. Appreciate it. But yeah, it's really interesting because that's a really large pullback. And so I think Nate will get to it, but what does that mean for the market? These iBuyers who have bought all these homes and are trying to flip them and now sell them. Does that mean they're going to go to a rent model instead because they need to make money on these and rents have increased substantially? Or are they going to try to sell these homes at a steep loss? And how's that going to impact their earnings for Q3? So those are the kind of the topics on my mind. I'm really curious how it actually plays out. But yeah, just an example.
Yeah, same. Yeah, and as we're looking at that, I did want to put up, Zillow offers, quote unquote, this is what they indicate on their website, offers 2 minutes or an offer every 2 minutes. This is obviously when it was like starting to take off when they launched, but they're tapping into all the hot markets. We got a heat map up as well. I mean, scroll over some of those. I mean, we've been looking at the market quite heavily, but if there's anything that stands out to you, because I mean, there's some pretty heavy ones. San Jose is heavily inundated right now with offers. Yeah. Stay away from any dark color on that map.
Yeah.
I mean, that's like the hottest market. You're paying a fat premium to just purchase there. So if you can afford a down payment and are willing to lose a little money along the way, feel free to do so. But it's getting hot out there. And, it's been reported that these iBuyers, if you will, like Zillow, OfferPad, I'll talk about here in a second as well, is these folks are putting in money, but they're really only like 1% of the whole market as a whole, right? There's all these other investors. There's the banks, Wells Fargo's predominantly used to be the prime originator of loans and so forth, who held a pretty heavy portfolio. But nonetheless, as we're looking at the technology taking over and looking at investors coming in, there's a lot of refinancing happening simultaneously as well. So you're seeing some of these pocket areas along the coastal side, at least, starting to take off, and hopefully going to be slowing down here in the near future. But very curious. Do you have any thoughts on that? Briefly, while we're talking about this stuff.
Yeah, 3, 2, 5. We're gonna do the tourney. We're on the same page as you. But yeah, I mean, I think it's really interesting. I mean, for me, it's just how is this gonna change the housing market and how is it gonna impact prices? I
Right.
think, and you can correct me here, but I still think iBuying is a pretty small percentage of buying, right? It's like under 10%
Yeah, they only
of
did
purchases.
15,000 homes. Yeah, I was trying to find the
Yeah.
article, which represents roughly 5.3 billion, I guess, in the second quarter. But even then, it seems like a lot of money, but it's not, considering the
Yeah.
value of the homes that have grown exponentially, like double in the last year. So when you think about it that way, but the previous record was 10,400. It's slowly increasing, but this is four competitors, top competitors, if you will, that have now entered the market. OfferPad being one of the latest, who went IPO. Their shares went up last week, up like 37% after news that JP Morgan Chase is going to invest 300 million into them, with a couple different loan structures to allow them to grow. But we were kind of talking about this earlier. It's interesting to see that I think they're going to be losing money here very soon, and I wonder if they're going to be kind of the unicorn Uber-esque type companies that investors are just going to keep hacking money at, assuming that
Mm-hmm.
they're going to be able to get their money back at some point, whether it's now or in the future. But I think they're going to be left holding the bag, man. Like, I don't see this being a
No.
sustainable
Shot
process for
themselves in the
them.
foot. Yeah.
Yeah, they're a little opportunistic, right? But
It's like I think
looking
this
at that.
like so like for an example in this house as an example. So obviously Austin is a specific market in terms of like where's the freaking chart? And in terms of home appreciation, but like this home, where's the freaking graph? This graph is insane. So 2020 before pre-COVID, this house was valued at 300K.
Ooh.
From March to the top of the market in terms of Zillow on when was this? In June, the house was valued at 550, and that's when Zillow bought the home. And
Mm.
so this is something when I look at the homes that Zillow bought, I was doing some research on my own because I was really curious. Zillow bought a lot of homes from January to June of this year. A ton of homes because that's really when they started developing this model. They haven't really launched this iBuyer thing really drastically until this year, along with other
Yeah.
companies. And so for me, it's like obviously we had investors, big companies like what's the big one that was buying up a bunch of properties then turning them into rentals? Do you remember, Nate? What's that big financial institution or hedge fund called? Shoot, it's on the tip of my tongue. But we saw hedge funds and institutions
Look.
buy up a lot of properties that they're flipping into rentals. We see iBuyers hopping on the market, and we see a lot of relocating into certain markets. And so my thing is like, was this run up in housing prices artificial? And
Mm-hmm.
like
Mm-hmm.
Nate was saying, are companies like Zillow going to be holding the bag? Because the difference between them and maybe an investment company, those investment companies are buying apartments, buying multifamily homes, buying single family homes as investments for the most part to rent out. But what Zillow's doing right now, at least, is they're buying homes to flip them and to make money on the sell. So my thing is, does this mean Zillow's going to be held with a bag? And what does that mean? First for home prices, and second for Zillow as a company and a stock, because their stock, as we know, has gone pretty insane over the last since basically COVID
Yeah, and it's
started.
going to be
But
dropping here pretty soon. I'll pull up the stock. Was it BlackRock you were thinking about?
BlackRock, yeah, they've been
Okay.
buying a bunch of real estate.
I was going to say that, and I was like, I want to double check. Don't want to misspeak here. But yeah, Zillow within the last few days has been hit. I think people are starting to realize they're, we don't have access to their books, but I'm assuming they have so much going into this market right now that people are going to start questioning how they're going to, what's their exit strategy as they're moving forward through this process. But yeah, you got top 100 hottest real estate markets by appreciation right there. A lot of them along the coastline, a couple in the Midwest, if you will. But yeah, Austin, there you are.
37%. Crazy.
Yeah, it's crazy
It's
high.
insane. Yeah.
But yeah, I'm curious to see where things end up going. OfferPad, you have Open Door that's also involved.
Yeah.
Supposedly they're using algorithms, or they call ATTOMs, that kind of compares what we see on Zillow. When you look up a Zillow, it's like Zillow rates this as X amount of dollars, it's worth this much. And then, yeah, you just pull up a very important couple charts there that I had up a second ago.
Yeah.
But the median price is just
Interesting.
exponentially increasing right now. And so we were talking about this a little bit
It's
ago
like
as well.
30%.
Yeah, you're going to see, I think it's going to be a blip in history. You're going to go back 10 years from now and go, oh, it was a spike and then it came down. I think we're hitting that point in this market that people aren't buying. We've seen the sentiment, the consumer sentiment, inverse relationship to home prices to how people are willing to buy. Yes, there's stragglers. People are always going to want to buy. People buy by sentiment, not by their brains sometimes. But that said,
Emotion. Yeah.
it's all about the emotion. That's what drives it. So
But I'm curious what you think on this chart here, Nate. So on this chart, we saw that basically for these iBuyers,
mhm.
purchase price, which is basically home prices, kind of stayed around this 250 range from 2017 to 2020 and had this
Mhm.
blow off top. You know, we see that in stocks too, where something goes sideways and then all of a sudden it blows off top because of some
Yeah,
external factor or impact. And so I'm curious
yeah,
what you think. What do you think? And this is just speculative and just because it's fun to
yeah,
do, but moving forward, like, what do you think we're gonna like revert back to where we were pre-COVID? Do you think it's just gonna slowly trickle down, or
yeah,
come down a little
yeah.
bit and find a base and go sideways for another 2 years? Like, I'm
Yeah, I
curious
think
what
it's
you
going to
think.
stair step down. I think because Jerome Powell, the interest rates are going to remain. I think the banks are going to continue. You know, we could call it dollar cost averaging down, if you will, or whatever you want to put there. People are going to continue buying if the price is right, because like you said, you're looking for a house. The market's too hot. I think there's probably a blip of population, 10%, we'll call it. I don't know what the actual number is, but if there is a 10% folks that are just waiting to buy, they have money to purchase or at least make a down payment. I could see people buying on the way down, so it'll kind of kind of stair step down
Makes sense.
along the way. But Zillow, I think, kind of going back to them, I don't. Maybe they'll continue buying to kind of justify, like, hey, look, we're gonna buy on our way down and then start offloading to break even, maybe. But I also think they might be cannibalizing, their own business model,
Yeah,
where their agents, they were heavily relying on the agent fees to be listing and so forth, but now they're taking a transaction fee, seller concession fee for repairs and so forth. That I don't I don't know if they're breaking even or being close to even with that. And then you got this other graph. Thank you, that last one, also as well, or the last two for that matter, that really start to show the pricing of the homes that the average or median. I can't see on that chart, but the dark gray area is starting to dominate, which may or may not be a good thing depending who you are.
yeah, over
In terms of the
500K.
market share, yeah, the market share of home value prices are beyond 500K. Like, that's crazy. I think it's going to revert back. You're going to kind of see it do a V going up. Hopefully,
It's it's
yeah.
what I find
It's
really
just not sustainable.
interesting.
Yeah.
Yeah, what I find really interesting. So on the Zillow point, I think okay, so Zillow was like the main people in like renting homes and buying homes, finding homes to buy for a really long time. And I don't even use Zillow anymore. Like right now, I'm like homes. I don't even use Zillow. One, because I think their platform is shitty, but because there's other competitors that I think are way better now. Like
I
Nate and
agree.
I talk about housing sometimes, and he has like this MLS, this person that gives him access to MLS. I use Realtor.com a lot. Realtor.com is almost as good as real estate's giving you MLS access. Like they're pretty
Mm-hmm.
close. And so what I think happened with Zillow is they realized, wow, we're having other companies come through and focus on this part of the market so much that we
Yeah.
cannot grow revenue anymore. And so we have to figure out a new business model. And right here on this chart, what's really interesting, let me see if I can zoom in a little bit. What it looks like is it's been working for a while. It seems like they buy distressed homes. They
Mm.
bought it from sellers because their house appreciated. they fixed it up a little bit and pumped the price higher. But now when you see here, you see the yellow or the pink and the blue come together. That's showing me that their model doesn't work anymore
Yeah.
because they can no longer buy homes at a discount. And when you can't buy homes at a discount anymore, that means that your revenue, your profit margin on your homes decreases. And
Mm-hmm.
so it seems like their business model is starting to hit friction because of the appreciation in home prices. So it's really interesting. This graph is pretty telling on medium home prices and kind of showing that how much longer will this concept, this business model really function because of the appreciation in home prices. So I don't know. It's very interesting.
Yeah.
Interesting stuff going on.
It is. And to kind of wind down from that, there was, I'm sure folks have seen it, but this guy kind of went on a rant. Turn it up a
Let's
little
talk
so
about
you
the
can hear.
housing crisis. And
But
let's talk about some
he
what
is
ifs.
a real estate agent,
What if
supposedly
there
in the
was a
market
company
for
that
11
everybody
years.
used,
And it's got millions of views at this
to look
point.
for houses.
Bit of a
And
conspiracy
everybody goes
theory.
on there and searches for houses
Maybe it's
and
true.
bored
I'll
and
turn it up really
stuff.
quick.
And so
We'll watch
that
it
company,
30
they just
seconds
sit
or
back
so.
and they just collect all the data. They just know what zip code is looking at what zip code and how much those people can afford. Everyone's looking at this one zip code and everybody seems to be able to afford this certain amount. And let's say that billion-dollar company uses that information to go into that zip code and start purchasing houses. Because the people that are selling their houses, even though they sell it for a little bit less sometimes than what the home could actually be worth, and they pay these high fees to this billion-dollar company, it's a convenience factor. So this company's scooping up houses less than what they actually could cost. And let's say that company, excuse me, Canoe, that company buys 30 homes within a 2-mile radius. And let's say the price is $300,000. So they buy all of these homes for $300,000. And then on the 31st home, they buy it for $340,000. Even though they know all of the comps. Because most people have to get a loan. And if you get a loan, you have to get an appraisal, which means the appraiser is going to look at what homes have sold in the area for that size and that price per square foot. So they're paying cash. They don't need an appraisal. Why would they pay $340,000 for this 31st home whenever they've only paid $300,000 for these others? Well, what that just did is create a new comp. So when they go to sell these other 30 homes, that extra $40,000 that you could say this one sold for $340,000 just made them $1.2 million off that one neighborhood because they know from their research how much people can afford in that zip code. Weird. And let's say that then they're going to come in. They bought that home at $340,000 that still needs work. So they're going to come in and do the good old paint, spackle, and change the carpet and call it a remodel. So now we can sell them for $360,000 because we.
So, bit of a conspiracy theory, if you will, but nonetheless, maybe it's a reality. Who knows? Maybe that is the business model game plan, which is failing, as we are kind of alluding to right now. Is if they're buying them up in hopes to sell them higher. I think by virtue of that, it's debunked. What he's saying, which could be true, if if logistically that were to follow, but I think it's going in the opposite direction. And then you got the CEO of Redfin here, who came off very amistoso, friendly, just saying, "Hey, look, like if that were true, we'd be doing all this stuff, but we're offering other scenarios for these folks." And so it's interesting, tale of two stories here of who's right, who's wrong. I think when you and I were talking about it, there's a moral ethic concern brewing to the top here a little bit. What are you thinking?
Yeah, I mean, for me, it's like them pushing into the market. What impact is that having on prices for first-time home buyers? So, like for example, my wife and I, like, we're thinking of buying our first home. It's an option, just because we're thinking we might be in Austin for a while. Like, it might be worth it. But for me, it's like, oh, how much impact on prices are these iBuyers having? Because traditionally, you buy from a homeowner. Someone bought a house years ago. They're ready to sell it for some reason. You're buying from them. It's like a person-to-person transaction. But now it's becoming a person-to-business transaction.
Mm-hmm.
And so it's like, obviously, a person wants to make money, but a business has to make money.
Right.
And so it's like, I think that difference in mindset of like, oh, Zillow, like, we know we can buy a home from somebody under ask. So this article I'm bringing up says Open Door and Zillow paid 98% of the home value, so slightly under. Who knows about that statistic, but that's what they're saying.
Yeah.
And so it's like, oh, because they have this cash, they can buy homes from people under market value. And then what they say here is they generally sell homes at 109 to 1% 12 the market value. So they're buying homes under market value and selling them above market value. And it's because they're the market makers. Zillow, Open Door, these people are the market makers. And so that's where it's like, where does that morality issue come from? Where you're the market maker, you're not only buying the homes now, but you're also selling them. And so, are you monopolizing the market? And what impact does that have on home prices? Um, what does that have to do with? How does that impact negotiation? Because negotiation is a big part of buying homes. When you buy a home from someone, you're like, hey, like this is really messed up. Like you need to take this money off. It's not going to work if not. Does that? If they start owning more of the market, like does leverage go away for the home buyer? There's all these ethical questions that I think probably gonna start happening and need to start happening. I think the video you shared is definitely, it's a little speculative and conspiracy theory, but there is some truth, I think, somewhat to what he's saying.
Yeah.
But it's so early on, we don't know yet. Like they've just been doing it for a couple years, and at larger volumes the last year and a half. So I don't think we quite know the impact it's going to have on the market yet.
Yeah, it's interesting too, considering that this is an independent seller. I think you brought up a very good point. It used to be person to person, customer to customer kind of experience. Now it's a business to customer experience, where the relationship has shifted a little bit, and maybe even the reason for doing the transaction. It's now more transactional than it is. You're selling my home. The feelings have been removed. Now it's cash on cash, essentially at this point. But yeah, the fact that also I just have to say he's a direct competitor to them at this point, right? They're coming in saying,
Realtor,
hey,
yeah.
we could do something a little better. Yeah, he's 11-year veteran, if you will, of working in this industry, where you have this public company coming out saying, even though we're doing this at about 60 basis points, et cetera, we could do it better, faster than you. And so, which maybe they can. Their platform sucks. I think Dylan makes a very good point. They're a bit delayed in their information and so forth. But I think from a business model standpoint, this shift could work. I think they came a little bit at an awkward time, a bit opportunistic. They're probably going to hemorrhage some money at some point. I don't know when they're going to report it or how it's going to be reported. But they're definitely going to be losing some money, I think, here in the short term. Long-term play, more power to them if they could pull it off.
Yeah.
But
I mean, it's like, right, technology as it advances, what does technology do? It replaces industries. And what Zillow and Opendoor are creating is they're replacing real estate agents. They're replacing real estate agents. Yeah. And when you replace real estate agents, can become cheaper, quote unquote cheaper. Obviously, you're paying above ask, above market value. But in terms of fees, because there's a lot of fees with buying a home. You have to pay the real estate X amount of percent of the purchase price. There's 2 real estate agents for every deal basically, and then they both get paid out. And so on the flip side, there's one Zillow. And so what does that mean with people saving money? What's the average percent that costs to buy a house? So like if I buy a house, what was it, like 2 to 5% of the purchase
the buyer
price?
seller gets 3% of the that's the fee that they get for the transaction, the buyer and the seller agent.
3%.
And then there's closing fees, which is the legal fees. You have the closing documents that you have to do. There's, if you want to get nitty gritty,
generally speaking, like I'm trying to think, like by Zillow owning the process, do you save a decent amount of money based on percentage points that you pay for
a real estate agent? Your time. It's your money and your time, right? Because it takes time to get through the process. And if they can do it all in one package, if you will, it saves everybody a headache. But also, quite frankly, and I think Zillow has mentioned this, and it worked in favor of my family member, where they were able to pick a date that they wanted to move out and finish the process. And they had to move the date, and Zillow is very flexible. And so when you're thinking about it in that regard, and you're like, my closing date, I want it to be, the 31st of whatever, or the end of the month, wait, I need one more month because something didn't happen in my life that I thought was going to happen or whatever, they can adjust accordingly. And that factor alone, that brain damage, can save a lot of headache for people. If you don't have to deal with the agent, because then you're dealing so there's a benefit to this service, I think. And if a big player like this, it's a bit of like David and Goliath, if you will, where you get these little real estate agents, I'm saying little in relative to the industry, versus like Zillow and Redfin and so forth. If you have these agents that are trying to scrape by virtue of serving, people, connecting people, essentially a buyer and a seller, and the buyer saying, I need to be in this house by X date because I'm also selling my other house, and the seller's like, I got to be in this house. Oh wait, something came up. Now I got to stay another week or two. That transaction just got shattered. Like, people are going to have to start to capitulate to the other's needs to make that work. Where Zillow or Redfin can say, you know what? Maybe they charge a premium. You switch the date once, okay, it's free. Second time, we charge you 2% of the whatever it is. But there's a play there, and I think that's what you're paying for at the end of the day, as well as it's the time, but it's also the money and the convenience, all packaged in one.
Yeah, and I mean, I don't know because I've never been through the process, but I also want to say Zillow's saying they'll connect you with a local buyer agent, so they're not replacing the buyer agent. There still is so they're not eliminating all the agents, maybe eliminating one side, but they're not replacing an entire industry of workers, at least right now.
Right, and this one's a buy, so this is the flip scenario, right?
It's the opposite.
One is Zillow is buying a house from somebody. That process is like, boom, good to go. They'll take their cut. There are fees and repairs that they're going to want to do, whatever those are. I would say they were very paltry repairs. They did not do a whole lot to the house that was sold to them, and then they're trying to sell it for like $40K more or whatever it is, more than that. I don't know what the exact price is. I know it's a lot more than what they put into it and what they bought it for. But anyway, through that mechanism though, and then to your point, I think this is where kind of the good ethos comes in, like the feely good side of Zillow comes in. It's like, how can we give back to the community, if you will? They're going to connect you with an agent, a local agent that can finalize the contract with you. But from an iBuyer standpoint, they're going in and buying the house, then they own the property, then they're able to outsource it to a local agent that can finalize the sale of their property. But the buying process is a completely different transaction than the selling on this side. But everybody has fees. Everybody needs their cut at the end of the day. So I'd be curious. Redfin, Open Doors, the other one that just went IPO. Zillow. Let's see. Online platform. Blah blah blah. Yeah, this is all SPAC info back here. Because they just went IPO or SPAC, reverse merger, in the last month, 30 to 45 days or so. So, I mean, they're creeping up as well. And since they're fairly cheaper than Zillow and Redfin, I think people are going to be buying into this. The market cap's 12.3. Yeah, 5.72 billion Redfin. Jeez. So, but
double the market cap.
Yeah, at least. I mean, Zillow, I went through their financials. But they got kind of I wouldn't say a high float, but I think that's an ever increasing float. Market cap 23 billion. These are big companies. Performance, you can see, is actually not doing so well. But did you have anything else on that? And then I'm going to kind of flip to a quick light item, and then we'll end it there.
No, I think that was it. I think that's I think brought some good points, some interesting content. So yeah,
I agree. So I just wanted to put this out there because we do talk Ford, GM, all these, the EV world we were talking quite heavily about. There's some cheap electric vehicles coming to the market. Yes, in the Ford Lightning capacity increase, they're looking at ramping up 80,000 units a year. That's going to be pretty interesting, the truck market, F-150s. But yeah, the electric vehicle is kind of interesting too, just the different types that are starting to come out. Some pretty cool ones, concept designs. 50K. I mean, these used to be 60, 70 plus K, a lot of these vehicles, with the exception of like Chevy Bolt. Those were always like 40, 50K. But they're all coming down fairly quickly. I mean, look at the 17.5 for this one, the CS. Oh, here's your Xpeng. Oh, 25K coming.
Xpeng's my shit, bro. Xpeng is going to be the biggest electric car vehicle in China, guaranteed. I
Yeah,
guaranteed
okay.
everybody.
What is this?
It will be
Electric
the
import car
biggest.
pack yak? What the? I'm gonna
Ooh,
buy
that
one of
thing's
those.
saucy.
I'll buy one of those for everybody if we get if we ever get 1,000 subs. I better not say that because that might happen someday. Uh, but yeah, tax credits and everything definitely play into this as a component to see how these are going to actually hit the market. So I'm curious to see at the end of the day as we move forward what that looks like as well. But
Yeah.
I thought that was kind of interesting. This article was recently released, and I was like, oh, dang! I know we talk a lot about these cars. I'm curious to see like what they're putting on the market out there fairly soon. And so, yeah, prices are coming down. Plus,
It's crazy.
the tax credits and all that stuff that are coming out. NEVs don't qualify, but
I mean, you
yeah,
couldn't buy, like you were saying, like 4 years ago, you couldn't buy an electric vehicle under like 40K.
yeah.
Like
And now you got,
40K was the minimum.
and most are under 40K at this point. Like it's
Mm-hmm.
crazy how far along we've come.
So just imagine another 4 or 5 years.
Yeah.
They're gonna be as cheap, maybe even cheaper, because I don't know
Mm-hmm.
what. I'm assuming the motor is the most expensive part of a vehicle, right? So
And
I'm
batteries, I
assuming
think.
in batteries, but I
I
mean
think.
not all electric vehicles. So
Oh,
I'm curious that once technology advanced enough where it's cheap to build batteries, like will cars eventually be cheaper than traditional gas vehicles? I'm curious.
right.
Be interesting.
I would say, speaking of batteries and
Ford
stuff,
Mustang.
LKKF. We've talked about this numerous times in different streams rather. But they're an OTC.
So
They
long.
do brine lithium to get the batteries. What do you call
I
it?
hope they
Components to
break
make the
50
batteries.
this week, man. I hope they
Man, if
make
they
50
break 50, that would
cents.
be amazing. So this is a company out of Australia that is doing. They just got it. They secured a deal and a partnership to do another mine, 150 million plus dollars to do some other stuff in other
So
areas. But
yeah,
yeah, man, I think they're gonna.
lithium is like the major component you need essentially. Like that's the
Yeah,
lithium ion batteries.
lithium. Yeah, got
It's the
cobalt in
main
there mixed with a
component.
couple other
Yeah, and
special
cobalt,
metals,
yeah.
but
The main one.
yeah, we'll see what happens. Yeah, LLKKF, and that's always going to be on my radar. But we will end it there. As you know,
Oh
we
yeah, attorney
game.
time.
We game
You
as well.
win.
So thank y'all for tuning in on this one. We're gonna end
Appreciate
it
it,
here.
guys.
Pump the stream back on here in a second. We are gonna play because this is where we play.
And you win.
There it is.